Bloomberg Audio Studios. Podcasts, radio, news.
I'm really jealous that you're taking 2 weeks off.
Yeah, I'm pretty
already
checked out, man.
I wasn't going to say that, but I was going to say you're already pretty tan.
Yeah.
I feel like, so I'm excited to see you after 2 weeks in the sun.
I'm going to work very rigorously on my tans.
Good. I mean, wear SPF, please.
Yeah.
Do it responsibly.
When I come back, I'm going to be like the color of this table.
Whoa. For those
can't see the table
listening at home.
It's
a handsome mahogany. Oh,
I don't
know either.
It's plastic.
It's not real wood.
It's not real wood. Maybe it is. I don't know. What do I know? But yeah, so I'm out for the next 2 weeks.
Mm-hmm. I'll be here. Yeah.
Enjoy. Keep me up to date on the gossip.
Yeah, plenty of tea. I'll keep the tea flowing.
Yeah. So this episode is coming out this Friday. Mm-hmm. We will have a mailbag.
Mailbag.
I'm going to say we're going to have a mailbag the following week.
We're recording it directly after this episode, so it's actually still up in the air. we have to see if we
we'll cut this
enjoy
out,
it.
Potentially. But probably we're going to have this episode out on August 8th and the mailbag out on August 15th. And then on August 22nd, you'll be alone with your thoughts.
Money stuff will go dark, but it'll be okay. I think we all need that reset.
It'll be August 22nd.
Yeah. You know, actually,
no one will want.
I won't even be on air that day because it'll be our
financial markets shut
our
down.
Jackson Hole special. So let's all just enjoy Jackson Hole together. You know, take a look at some central bankers in front of mountaintops, and we don't need to listen to a podcast that day.
But you do need to listen to a podcast today.
And we're going to really try hard to make this one good.
You might. Hello, and welcome to the Money Stuff Podcast, your weekly podcast where we talk about stuff related to money. I'm Matt Levine, and I write the Money Stuff column for Bloomberg Opinion.
And I'm Katie Greifeld, a reporter for Bloomberg News and an anchor for Bloomberg Television.
Katie, I feel like I follow Elon Musk's pay more than...
He does.
More than... I don't think that's true. By the way, I follow Elon Musk's pay. It is rumored that he follows my vacation schedule and schedules his most insane activities for when I'm supposed to be on vacation so that I have to write about them. I don't think this is true. I don't think he consciously does it.
We're going to find out.
Does it, but we're going to find out.
We're going to test this.
Here I am talking on a podcast about taking 2 weeks off. So if Elon does something really egregious in the next 2 weeks, you'll know why.
Well, he should be happy. Right now. He got
What, you think $30 billion makes him happy? Fine.
It's... You know, I have to imagine maybe he's not completely happy, but he's a degree happier than he was, perhaps. So
the news is that Tesla's board announced that it's going to give Elon Musk an interim award of $28 billion worth of, I was going to say stock options. It's slightly more, it's like restricted stock units with a strike price, but it's stock options, whatever. They announced they're giving him that as basically a good faith payment because, as we've talked about on this pod a lot, he was awarded a bunch of options in 2018. They were all contingent on him making Tesla a giant company. He made Tesla a giant company. He got the options. They're worth something like $87 billion today. And then last year, a Delaware court said, no, those weren't valid. They go away. And so now Tesla's in this weird bind. They're like appealing the decision and stuff. They're trying to get him back that money, but there are various governance and tax and accounting and legal complications around getting him back that money. And they're still kind of figuring out how to do it. But as a good faith down payment on their desire to give him back those options, they gave him back $28 billion of them this week. So you asked if that made him happy. One thing I wonder is, was it a surprise? Because like the previous set of options, like he sort of negotiated with the board, you know, like in 2018. And like there was obviously like, you know, this is an incentive package that, you know, we're giving you these targets that are super ambitious, but, you know, you think you can meet them. So that was like a employment deal that he struck with the board.
Right.
This is like, this could have just been like, surprise, here's some of your money back. It's possible the board did it without him. Which would be kind of funny if he just woke up one day and like, you know, had a $28 billion transfer in his bank account. That'd be pretty cool.
Why $28 billion? Why not just make it $87 billion?
Part of it is like, they're still figuring out what's happening, right? So this is like a down payment on figuring out the whole answer to this question, right? If they win the appeal, this award goes away and it's probably easier to have given him less while they're on appeal. I think it's possible that part of the answer is that, funny that this is to say, that Tesla's board of directors and the special committee that gave him this award are independent and are thinking about their fiduciary duty to Tesla's minority shareholders or outside shareholders, and are thinking not only what would be nice for Elon, but also how do we motivate him to maximize the value of the company? And it's possible that giving him all of the options right now is not the answer to that question. It's possible that like the ultimate structure they'll come to is something like you get $30 billion of this stuff and a new award with new targets that requires you to do new stuff. Mm-hmm. But for now, they gave him this award, and it has essentially two contingencies. One is that he has to stay there for 2 years, which who knows? And the other one is that it goes away if they win the appeal. So if he gets all the previous options back, he doesn't get these options.
The 2018 options.
Yeah. So if he gets that like that $87 billion, this is not additive to that. Like,
so no double dipping.
No double dipping, as they say. Yeah.
You talk about this a little bit in your column that, okay, it has these strings attached. It's contingent on him staying there for 2 years.
There are very few strings.
Well,
like, sure, he has to stay there for 2 years, but that's like a $14 billion a year pay package.
But isn't it a little weird that, okay, you have to stay here another 2 years, but also this is making good on our promise for things you already...
Yes, I agree with you. It's a little weird. If their mentality is truly like, we owe you this and we're giving it to you no matter what, then you're right. He shouldn't have to stay there for 2 years. But I don't think they can really do that. I think they really have to be like in a posture of like, we are maximizing value for the shareholders and we have to get something going forward from it. And if we're just giving Elon Musk $28 billion on his way out the door, then that is not a good use of shareholder resources, even if it's in some sense fair.
True.
Also, like, it doesn't seem like that big an ask.
Mm-hmm.
Like
to stay there for 2 years.
It's like, his main source of wealth, more or less. And also, like, it's not that big an ask in the sense that, like, you and I, if we got, like, a great job opportunity, we'd have to sadly quit this job to pursue that great job opportunity.
I would never.
That is not a problem for Elon Musk. He can have as many jobs as he wants. Like, they're not requiring him to only work at Tesla for 2 years. It's just, like, to have it, have his name on the door for 2 more years.
Continuously, right?
Intermittently.
Yeah.
On alternate Tuesdays. So I think it's fine. I think it's like not a big ask, right? Like he can spend 100% of his time elsewhere for 2 years and still be the CEO of Tesla. So
yeah, which is kind of what's
job.
Some would argue that's what's been happening already.
Many would argue.
So just keep it status quo.
And I think, again, like the board, like they're doing two things, right? They're trying to be fair to Elon, which I think is like a legitimate concern. Like I think the board thinks and Elon thinks, and I think they have a real point that he earned this $87 billion of options, and so he should get them. And just retroactively, he should get them for his prior work, right? So they're trying to be fair to him, but they're also trying to, do good things for the company and situate the company well going forward. And so, their announcement is not just like literally like he has to have his name there for 2 more years. It's like we need him to focus on building AI and like attracting talent to this company because we're in an arms race for AI and Tesla is an AI company. Katie's rolling her eyes. It's reasonable because like Elon Musk does have an AI company that's not Tesla.
Yeah.
But like Tesla is,
it's valued like an AI company.
Right. It's not valued like a car company that sells as many cars as it sells, right? It's valued like the future of
life,
robotics, AI, something. And so to, live up to that valuation, they need to keep him around to be their futurist in residence.
Yeah. I anchor a television show with Matt Miller.
Really?
Yeah. And
how about that?
He's a car guy. So talking about Tesla makes, smoke come out of his ears when we talk about the fact that it's $1 trillion company. You add up the market caps of the big three, Stellantis, Ford, and GM, and it comes out to less than $150 billion, which shocked me. Actually, I didn't realize it was that low. So $1 trillion. Yeah. I wanted to talk a little bit more about the fact that, okay, if we're talking about this options package, the $30 billion one, so Tesla would take an enormous tax hit if this happened.
Well, Elon Musk would take a tax hit, I think.
Elon Musk would take a tax hit. Tesla would take a hit to their earnings, correct?
Yeah, basically the way it works is that when they granted the options in 2018, they were, for accounting purposes, kind of worthless because they were at the money So they were not like a gift of stock that day. And because they had these really aggressive conditions where, as like a $60 billion company, he would have to grow it into a $650 billion company to get all of the options. Mm-hmm. And so you can go to your accountants and say, that's not very likely to happen. So the value of this grant day one is not very much. When they do it retroactively now, the value of the grant day one is, kind of $28 billion. But they apparently, this is in the disclosure, and it's a little unclear why, although I have my assumptions. They apparently went to their accountants and said, it's very unlikely that he'll get these options, and so they're worth nothing.
Yeah.
And the accountants agreed. And so they say right now that they plan to not incur any expense for the options because it's unlikely that the performance conditions of the options will be met. But there are no performance conditions. Mm-hmm. So we talked about the two conditions, which are, one, he has to stay there for 2 years, and two, these go away if he gets back the previous tranche. Like basically if they win on appeal in the court case.
If the Delaware decision is overturned.
Yeah. And so what I think they're saying is that there is a less than like 25% chance of both of those conditions being met. That is, either they're very confident that the Delaware decision will be overturned, or they're very confident that Elon is going to quit in the next 2 years, or they believe like the joint probability of neither of those things happening is very low, right? Like they think if the decision is not overturned, he'll quit, something like that. So this is a funny little, like, I don't know what those conversations with their accountants were like, but I found it amusing that they would not have a high degree of confidence of him meeting these very limited performance conditions.
But it seems like, I don't know, listening to that they seem somewhat confident that the Delaware decision will be...
Yeah, it's weird to go to your accountant and be like, this 100-page opinion by the Delaware chancellor is obviously wrong. And the accountant's being like, yeah, it's obviously wrong. That's going to be overturned. And then like, I don't think they got a legal opinion saying this is definitely going to be overturned. Maybe they did. I don't think it's crazy, by the way. Like it's kind of a weird opinion. It's kind of a weird outcome. Like there's this weird political environment where Delaware is losing companies. You could imagine it being, there's the reasons it would be overturned, but it's not like, oh, it's definitely going to be overturned. Mm-hmm. I don't know.
History in real time. And we are chronicling it.
Not for the next 2 weeks, we're not.
That's true. Who knows? It didn't say anything about his political activities. Like you think about serious overhang over the stock.
No, you're the Tesla board and you're like, okay, Elon, in order to get your $28 billion of options, you have to not do a list of bad things, right? Where the list of bad things, like, okay, sure, it starts with like enraging customers by doing political activities and then it goes on to like ketamine and like, running 7 other companies. Like, no, he would much rather have his complete freedom to do whatever he wants than $28 billion. I mean, I'm speculating there, but
I talked to him this morning.
I don't know. Like, it's easy for me to say. I'd rather have the $28 billion.
We're just talking about funny money at this point.
Right. He's like, right. We are talking about funny money at this point. Like, he lives in a state in which if he wanted any number of dollars to do anything, he could snap his fingers and it would like magically appear. So like there is a sense of fairness. There is a sense of like, wanting to have a certain ownership of Tesla. There's all this stuff that goes into him wanting to have tens of billions of dollars of Tesla options. But like if he needs money to do something, he'll find money to do something.
He's going to be all right, guys.
He's going to be fine.
Elon's going to be okay.
I mean,
How about corporate access?
How about corporate access?
Bradley Sachs over at Business Insider, Bloomberg alum, great piece out.
About like the big hedge funds and corporate access. I love corporate access because it's like, it makes no sense.
No.
It makes total sense, but it makes people insane. Corporate access is like investors, largely big, institutional investors, hedge funds and like mutual fund managers. Investors like to meet with the companies whose shares they own and the companies whose shares they're considering buying, and they will sit down with the CEO and be like, so, how's business? And they learn things in these meetings.
Theoretically.
No, theoretically they don't, right? Because the U.S. has rules saying that Regulation FD says that companies can't disclose material non-public information to some investors without disclosing it publicly to everyone. And yet these meetings happen. And you know that they learn something because, one, they keep doing the meetings, right?
This is true.
You know, people don't waste their time for no reason, right? Like they think they're learning something. And then two, you know, it's like a little hard to study, but there are some empirical studies where academics like look at these meetings and they find that investors who have meetings with management then make more informed trading decisions than they do if they don't have the meetings. So it's clear that these meetings have some value.
Yeah.
And, you know, it's like this gray intermediate area between they can't get material non-public information, right? Like the company can't be like, oh, our earnings are going to be really good next quarter if they haven't already given guidance on the earnings. They can't be like, oh, we're getting acquired next week, right? They can't give like big material information, but they can talk about how they think about the business. They can like, you know, talk through the model. They can do a lot of helpful stuff for the investors where the investors come away learning something without being spoon-fed next quarter's earnings.
Yeah.
The thing that people always say about this to make themselves feel better is that the investors can get a read on the executive's tone and body language, which is like on its face absurd.
Yes.
But people keep saying it. They're like, oh yeah, they don't say anything that they haven't already said, but the body language tells you something.
So I feel
what
like
does it tell you?
It probably lost its edge during the pandemic when we were all on Zoom and it's a lot harder to see.
Oh, that's an interesting question. I feel like there are studies and I don't know them because like that would tell you something, right?
Yeah.
If it in fact lost its edge on the pandemic, then that would tell you that tone and body language mattered a lot.
Yeah.
And when people were only getting Zoom calls, they got less information.
Whereas
my thesis is that in fact they're being told information and tone and body language is just a euphemism. And so in the pandemic, if you get on a Zoom call and you're like, so walk me through how you're thinking about strategy, and the executive tells you, they're like still informative. You know?
Yeah. Someone should do that. I don't know.
Yeah, probably someone has.
I guess I come at it from a skeptical lens as a journalist who talks to a lot of CEOs. Not to besmirch any CEOs, but a lot of them just follow the script. And I mean, you listen to them speak at conferences and, you know, it's hard to get new news out of someone in the C-suite.
Okay. Maybe 3 answers to that. One, you don't own 5% of their stock. It's possible that a conversation with an investor is a different framework from a conversation at a conference with a journalist, right? Like they're media trained, but they're trained differently to talk to investors, right? Two, you do not have CIA interrogators to understand their body language, which apparently some hedge funds do. And then, wait, did I have a third point?
You said you had three, so
I said I had 3
you got to
points.
think of something.
Okay.
I'm reading your body language right now, and it seems like you're really trying to think of
I
one.
had 2 points.
Okay.
The third point is like, you can imagine the investors asking different questions because they're not trying to make news that's like they're trying to make very incremental news, right? They're trying to find out like update their model.
Well, that was part of the piece. Bradley wrote about how one of the complaints is that the questions that are being asked are like becoming so niche to the point that they're not useful anymore.
Oh, I know what my third point was.
Okay.
My third point was that actually in this piece, several investors complain that in fact, they have the same complaint you do, which is that the CEOs are now so scripted that these meetings have become less useful than they used to be. Yeah. Not just because the questions are very granular, which is like their questions are granular because hedge funds are competing to like add extremely granular information to like the information set. And so they have very detailed questions, which sometimes annoy CEOs who want to talk about like the big picture.
Big picture. Come on. Here's my strategy. Isn't it great?
Right. I mean, the thesis, like the point of this piece and what I wrote about it is that like in my world, you think of like the prestige and importance of investment firms. And like right now, the big four multi-strategy hedge funds, like the Citadel, Millennium, Point72, Balyasny's of the world, are really like on the ascendant. Like they're really prestigious. They're really sort of top employers in the asset management business. But when you think about what a CEO wants, they don't want to meet with those guys. They want to meet with Fidelity and Wellington. They want to meet with long-only managers for a number of reasons. One of which is that the long-only managers have longer tenure, both like they hold the stock for decades and also like they employ portfolio managers for decades. Whereas like, you know, the big hedge funds, they're constantly churning through portfolio managers and they're constantly churning through stocks. And so like if you talk to Citadel, because they own your stock this week, they may not own it next week, or it may be a different person. You know? But there are other reasons, one of which is that the hedge funds have these really granular questions. Like they're really interested in like what's going to drive the stock in the next couple of weeks. And so they're not going to ask you about your strategy. And if you're the CEO and you're like want to pontificate about the big picture for a while, you'd much rather talk to a long-term, long-only investor than to a hedge fund who has like very specific questions about margins. And then the other reason is that they're all 27 and wearing T-shirts, and the people at Fidelity know how to dress to meet with the CEO.
Just amazing.
Yeah, it's like literally true that like 0.72 now mandates blazers because like they were having trouble booking meetings because they
Too
didn't
many
dress
27-year-olds and whatever. Yeah, that was a fun tidbit. I also, and this was partly addressed in the article and in your column, I feel like part of the reason that these meetings are in such high demand is just because time is finite, you know, and anything that's scarce is going to be valued, and time is scarce, and time with these CEOs is scarce.
Yeah.
So even if it doesn't add that much of an edge, you still have it.
Right. I think there's an enormous culture in finance and business generally of like, if you think that doing a thing has a 1% chance of adding 1% to your returns, you're just like hardcore and you do it anyway.
I gotta get it.
Right. Like I have transcended that. But like, you know, you're in that seat because you work really hard and like sort of do everything you possibly can to get edge. And so even though the meeting will probably be worthless, you'll go to it anyway. But the other thing about scarcity is that at these firms, you know, like the big hedge funds will have multiple teams trading the same sector.
Yes.
And so, you know, if you're the CEO and you book a meeting with Citadel, there's like 5 PMs at Citadel who are fighting each other tooth and nail to be the one in the meeting, or like the 2 in the meeting, you know?
Honestly, it reminded me so much of working in a large newsroom.
I know. I was going to say, right.
Yeah.
Right.
Like it's very, you have a beat and you're pretty protective of your beat. And it's funny to read about it becoming like part of a recruiting perk is that you're the only person covering this. You don't have to fight for your lane. This is only your lane.
Or it's even worse. It's like Bradley Sachs writes that like the most tenured PMs will often get the best meetings. Mm-hmm. Like, you know, if Citadel has a meeting with a company, they'll be like, the guy who's been here the longest and like does the best work gets to have the meeting. Mm-hmm. But like sometimes they'll hire someone and like the new guy gets the meeting because that's like a recruiting perk. And then the long tenured person doesn't get to go to the meeting. And it's just like,
there's a lot of parallels.
Right. No, right. Like I've been in meetings with like many other journalists where 1, it's competitive to get into the meeting, and then 2, everyone's got like, you know, it's competitive to get your question answered.
Yeah.
And it seems similar in this case.
It's so funny.
The other thing I wanted to say is I wrote about this, and I wrote about, broadly speaking, CEOs would rather meet with like Fidelity or Wellington than with Citadel or 0.72. And then as a throwaway, I was like, and they probably won't meet with, you know, if you own 100 shares and you're a retail investor, they probably won't meet with you. And I found an academic paper I wrote about Wednesday where they basically tested that out by sending cold emails to a lot of investor relations departments. Mm-hmm. And the cold emails, some of them were from like a yahoo.com email address. Mm-hmm. Like, hi, I'm an individual investor. I'd like to buy your stock. Could you meet with me? And some of them were from fake investment firms. Like,
amazing.
I work at Blue Willow Capital and I'd like to meet with you.
That sounds right.
Yeah. They found, first of all, that about 16% of these messages resulted in meetings.
Okay.
Which is higher than I would have thought.
It's not bad.
Right. And second of all, there's no distinction between retail investor and Blue Willow Capital. Like retail people could get the meetings just as easily as Blue Willow. They did find racial discrimination though.
Oh.
Yeah.
Don't love that. This reminds me, we were talking about Hims and Hers earnings on air this week, and the Hims and Hers CEO has made sort of a big show of like giving questions in the earnings call to retail investors.
Yeah, right. Like my perception of it being hard for retail is kind of an old school perception. And now with like meme stocks, it's a different game.
Yeah. Also, somewhat related to this, I was talking to a CEO who reported earnings this week, and the CEO said that, okay, if you report in the afternoon, then you do the earnings call, but then the CEO was answering questions from analysts until like 10 p.m. that night. Like you have the earnings call and they ask the questions and the transcript goes out and you can see it, it's public, but then like the real questions come after the earnings call. So you have the earnings call and then you have all your individual calls.
And this is the thing that people naively think Regulation FD prevents, right? It's like everything has to be public, but no. And you see it on like public earnings call transcripts, you know, people ask questions and the CFO will be like, follow up with me afterwards and we'll walk through that, right? And like, you know, like it's obviously the case that companies talk to analysts and investors outside of the, you know, 1 hour public earnings call. And it seems to be obviously the case that those conversations are useful, but they exist in this weird regulatory limbo.
I find that frustrating because as a journalist, I'm not allowed to sit in on those one-on-one meetings. Yeah. Should we check in on the state of Oncycle recruiting?
Let's check in.
Bank of America.
How's that today?
Yeah. Well, Bank of America, the news came out this week, written by Catherine Doherty, that their junior bankers face reassignment if they accept other jobs. Just the latest in a string of the big banks pushing back against Oncycle recruiting.
Right. So
it's been a busy summer.
One thing I wonder about is, like, why are they pushing back? Like,
why are they pushing back in general?
Like the dynamics here are like J.P. Morgan led the charge of saying, we're not going to allow on-cycle recruiting. We're mad about it.
We'll fire you.
And then a number of big private equity firms announced they would wait to do on-cycle recruiting.
Led by Apollo, it feels like.
Most banks did not join in saying we're going to fire you. And most private equity firms did not announce we're not going to do on-cycle recruiting for 2 years. But also didn't happen. Like, everyone is like quietly, tacitly going along with this process started by J.P. Morgan. And it's like a two-sided process. Like the banks and the private equity firms, everyone seems like to have, there's like a possibly fragile equilibrium where they're not doing the recruiting. And so there's not really a need, I don't think, for the banks to say, we'll fire you if you do it because it's not happening. But, you know, you got to get ahead of it. So some of the banks are joining in. And so this week, Bank of America said, if you accept an offer elsewhere, you'll be reassigned, which is very ominous because they don't say where. And like,
Equities in Dallas.
Bank of America has tellers. Like,
oh my
a lot
God.
of possibilities.
Yeah, that was more dire than I was thinking. They
don't say.
Yeah.
And it's, you know, like the idea of on-cycle recruiting is so strange, right? But essentially it's you will, at the beginning of your investment banking analyst job, accept an offer at a private equity job. But that private equity job is contingent on you spending 2 years being an investment banking analyst because you do need to learn the stuff that you do as an investment banking analyst to be an effective private equity associate. And so you have 2 years of working in, you know, an industry group or an M&A group or a Lev Fin group at a bank where you like learn enough to become a useful associate at a PE firm. And if you get fired at your bank, the PE firm will probably rescind your offer because you haven't done the training that they require. And if you get reassigned to being a teller, then like also not the training they would have wanted.
Yeah, you can kind of feel for these analysts because also they're probably not having a lot of fun in general.
Oh, sure. And like, one thing reassigned could mean is like if you work in the tech group and you get a job at like a tech-focused private equity firm, then Bank of America will say, okay, we're going to reassign you because there's conflict of interest there. So we're going to move you to like the natural resources group. Like that would be like a fairly benign interpretation of this. One doesn't get the sense that's what's happening, right? You get the sense that it's like a punitive reassignment.
Yeah, going by what the story said, this is according to people familiar with the matter, junior bankers are being asked by their managers to divulge whether they have a new employment opportunity, and if future offers are accepted, those individuals will likely be moved to another area within the bank. So searching for detail there. But they have a week. Apparently, those who fail to disclose accepted offers within a week would be deemed in violation. It's interesting to see how different banks are approaching this. Apparently, Goldman has you...
Right, Goldman has the carrot approach where they're like, well, sorry, they do have...
Well, you have to restate your loyalty every 3 months or something.
Yeah, every 3 months you have to say you haven't taken a job elsewhere.
Yeah.
But they also have like, you know, there's like 3 tiers of prestige, right? There's like private equity, and then there's investment banking, and then there's like operations, back office, tellers, right? And Goldman says, if you stay here for 2 years, we're going to try to move you into our own, I was going to say private equity division.
Yeah.
Their own like alts division, which is private equity-ish. And then Bank of America says, if you don't stay here for 2 years, we're going to move you into being a teller. So.
Gosh. Yeah. So Jamie Dimon, it feels like he started this all off a couple months ago.
Yep.
I do wonder, like, if it had been Wells Fargo who led the charge, would we be seeing this cascade of other banks lining up and saying, we're also not okay with this. This is what we're going to do. Or is it uniquely like Jamie Dimon and JP Morgan are doing this and all the other big banks feel pressure to follow?
I think Jamie Dimon has a lot of like moral leadership. I don't even know about the other banks feeling pressure to follow.
Yeah.
The other banks feel cover to follow, right? Because like this is a competitive market. And if one bank says, and this has happened before, if one bank says, we're going to fire you if you take a private equity job too early, and no other bank says that, then people won't go work at that bank because they'll want their private equity job. But if JP Morgan says, JP Morgan's pretty big, and so you have cover. But the other thing is also the people who run private equity firms care about what Jamie Dimon thinks.
Yeah.
Not even as a markets and competitive matter. Just oh yeah, they respect that guy.
Yeah.
And so when he says it, they're oh yeah, he's right. Because by the way, everyone knows he's right. It's not super controversial. No one's that upset about it. And I think if you if you talk to the private equity people, they are not thrilled with the current process.
Mm-hmm.
The current process does not do a good job. The old process, the process where they, interview before people start at banks, does not do a good job of finding people who are knowledgeable. Does not do a good job of finding people who are really motivated, because you don't know anything yet. They haven't worked as bankers yet.
They're just a baby.
If you interview them after a year and a half in banking and they're dead-eyed and have built 1,000 models, it's easier to find out who really wants to be there, who's really interested, who's learned a lot. Mm-hmm. And so it's a better system for them. And then the other thing is, we live in a very uncertain world about the hiring needs of private equity firms 2 years out.
That's true.
Right?
Robots are coming. Heat death of the universe.
The deal flow situation is
right. That too.
There's less need for associates right now than people might have predicted 2 years ago, and so why predict 2 years out when you can just wait?
Yeah.
And if everyone can wait, then everyone can wait.
So you called it the old system, and that
I'm sorry, the system as of 6 months ago. Yeah.
Right. Yeah. Well, I was going to ask, do you think that this changes anything? Have we seen the end of this cycle? Is this a lasting fragile, what did you call it? I liked that. Fragile equilibrium?
I think that between the AI stuff and the relative slowdown in PE, no one is desperate to hire the best possible 22-year-olds to start in 2 years. Those are separate points from Jamie Dimon's moral authority. I think in 5 years, in 2 years, if private equity is booming and they're desperate for people to do deals and the AI thing was just hype, and they think, how do I get the best possible 40 bodies and seats? They'll be interviewing earlier. These things always break down, but
I guess that's what a cycle is.
They break down because of competitive pressures, right? And if there are no competitive pressures for them to break down, they won't break down. So I don't know when that'll be.
So watch this space.
All right, goodbye.
Okay. All right, Matt, bye.
And that was the Money Stuff Podcast. I'm Matt Levine.
And I'm Katie Greifeld.
You can find my work by subscribing to the Money Stuff newsletter on Bloomberg.com.
And you can find me on Bloomberg TV every day on Open Interest between 9 to 11 a.m. Eastern.
We'd love to hear from you. You can send an email to moneypod@bloomberg.net. Ask us a question and we might answer it on air.
You can also subscribe to our show wherever you're listening right now and leave us a review. It helps more people find the show.
The Money Stuff Podcast is produced by Anna Mazarakis and Moses Andam.
Our theme music was composed by Blake Maples, and Sage Bauman is Bloomberg's head of podcasts.
Thanks for listening to the Money Stuff Podcast. We'll be back next week with more stuff.